Hello and welcome to Business Arena on TVP World. I'm your host, Marie Cato. Join me for the latest business headlines of the day. The National Bank of Ukraine has raised its key interest rate on Thursday by 50 basis points to 13.5%. The move comes on the back of rising inflation in the war-torn country. Inflation in Ukraine currently stands at a little over 11%, the highest level since last July. The central bank said that the uptick can be attributed to rising wages due to war-induced labor shortages and frequent power cuts. The country's central bank officials previously maintained that rates won't be changed until next year. Current Ukrainian forecasts see inflation ebbing in April for an average of 6.9% in 2025. Rates were also changed in the Eurozone, where the European Central Bank lowered the key rate by 25 basis points to 3%, a third consecutive cut. The officials also signaled a willingness to cut rates further to prop up Europe's ailing economy. As the Polish government wraps up audits in companies it has stakes in, a startling picture has emerged of waste, questionable deals, and a flurry of new cases heading to prosecutors. As a result, Jakub Jaworowski, the Polish Minister of State Assets, has promised that new management will strongly adhere to the principles of corporate governance.
1 year into the new Polish government's term, early findings from the state asset reviews are beginning to crystallize. Officials have already filed nearly 50 notifications to the prosecutor's office, with the total losses from ill-advised investments and unwarranted spending amounting to at least several billion zloty.
Now, we are trying and we will improve this corporate governance, but this will not happen overnight. And what's more important, the investors' confidence in our commitment will probably take more time to be regained. But we are committed.
After the previous management's tenure, certain projects have ballooned in cost. One example is the Olefiny 3 investment undertaken by Polish energy giant Orlen. While initial projections put the price tag at €2 billion, soon the cost went up by 3 times, and now it has doubled, bringing the total to €12 billion. Orlen Lietuva also saw expenses soar beyond initial estimates.
This year, we have written off approximately €3.5 billion due to such investments made in previous years. It's an alarming amount. Such write-offs cannot be explained by anything other than improper management.
However, the Olefiny 3 complex will not be scrapped, but scaled down to adhere better to economic reality. However, even after spending billions, it's expected that Orlen will generate less than 200 million a year from the plant. Orlen is not alone. Grupa Azoty, another chemical giant in which the Polish government has a stake, also encountered problems with a €1.5 billion facility for propylene and polypropylene production. PKP Cargo, a state-owned rail operator, is deep in the red after years of weak governance. Polish Post, the national postal operator, just announced deep restructuring to keep the economy afloat. As these revelations deepen, only time will tell if the new management's efforts will translate into a meaningful change and a healthier corporate culture.
Donald Tusk's coalition government wants to ensure that a proper level of corporate governance is implemented into the management and supervisory boards of state-owned enterprises. But as the Polish Minister of State Assets says, it will take time. To understand what this means in practice, stay with us for The Bottom Line. PFR Ventures, the largest fund investor in the Central and Eastern European region, announced it will provide funding to 5 new venture capital firms. With this move, the state-owned financial group aims to boost venture capital investment, which is currently trailing global leaders.
The success of the world's biggest companies, such as Google and Apple, has proven that venture capital is the most effective mechanism for driving startup growth. That's why PFR Ventures, a branch of a state-owned entity focused on fostering sustainable development and economic growth in Poland, is expanding its portfolio. On Thursday, it unveiled it will allocate €60 million to 5 venture capital funds, which target high-growth potential startups in sectors including financial and medical technology. Selected out of some 100 submissions, The PFR Ventures CEO Maciej Ćwikiewicz is optimistic this number will increase even further in the coming year.
We believe this market area is becoming increasingly attractive. The number of startups is steadily growing, and the potential for returns from these investments is always significant because these are markets that typically grow very quickly.
The funding will come from the European Funds for a Modern Economy programme, designed to support the development of innovative enterprises. PFR Ventures has already received nearly 500 million euros from the programme, with 35% of that amount still up for grabs. And there is a lot of progress to be done in this area, as venture capital investment in Poland, like in many other European countries, has a lot of catching up to do not only to the global leader US, but also are below the global median because the market is less mature.
We are lagging behind our peers, so there's more work needs to be done. But to be honest, the venture capital in Poland is relatively young, so we are probably a couple of decades behind some Western economies.
While in the third quarter of 2024, the volume of seed investments grew slightly on an annual basis, they are considerably lower than in the years prior due to the end of a funding programme. PFR Ventures, the biggest entity of its kind in Central and Eastern Europe, expects the programme to boost this number in the near future.
OMV, Austria's state energy company, terminated its contract for gas supplies with Gazprom. The move comes in response to the Russian company ceasing deliveries to Austria.
Another day, another lost customer for Russia's Gazprom. This time it's OMV, Austrian oil and gas company, in which the Austrian government owns substantial shares. While most European countries divested from Russian gas following the start of the war in Ukraine, Austria remained largely reliant on Moscow.
We will not let ourselves be blackmailed by anyone, not even the Russian president. We will not let Putin's government or Putin himself bring us to our knees, and we have taken precautions to ensure that we can defend ourselves for precisely this reason.
Gazprom stopped supplying gas to Austria mid-November due to a dispute over payments. Vienna sued the company over damages incurred as a result of interrupted deliveries in 2021 and 2022. Arbitration by the International Chamber of Commerce led to a decision awarding Austria €230 million in damages. Vienna refused to amp further payments until the decision was accepted and the gas bill lowered by the awarded amount. Gazprom refused to accept the ruling, and as new payments were not being made, cut the supply to Austria.
The fact is that actually the Austrian state has, I think, now reached something they politically wanted to do for quite some time, which is to actually end the Russian gas into the country.
OMV's claims to have a portfolio of alternative gas sources necessary to secure the deliveries to its customers. Other experts seem to agree with this assessment.
The National Oil and Gas Company has actually secured LNG capacities in Rotterdam and other ports, and they have also secured the pipeline capacities to bring gas from LNG into the country, together with, quite honestly, also a not insignificant saving of gas.
Austria's national gas strategy envisaged not only replacing the Russian gas with imports from other countries, but reducing the consumption overall as well.
And that's all for our business news updates today. For more business stories, check out tvpworld.com.